Hey traders, I wanted to make a video today on all of the different permutations or various ways that you can set up a zero DTE trade, a zero data expiration trade. And you've all heard the phrase that there's 1,000 ways to skin a cat, and in trading, boy, that is certainly true. One of the things that was a little bit challenging for me as I got started trading was to watch 2 or 3 traders, all very successful, all trading the same quote-unquote strategy, but applying it in different ways. And they're all getting good results with the same strategy, but they're doing it in different ways. And it's a little bit of a challenge when you can't definitively say one way is better than another, but they all have their pros and cons. And so I want to lay out just sort of the plethora of ways that we can and do approach our zero DTE trades, and you'll get a little bit better understanding, I think, of the pros and cons of each one of those. So let's jump in to these different types. I want to go through with you basically 6 different ways that we can and do approach our zero DTE trades. So one of the first things that we need to have when we start trading any approach or strategy is a set of rules that sort of set us up for our trading. And one of the first things that we need to think about when we are doing zero data expiration trades is, what is our focus or approach to understanding what the market's doing? Is it a technical approach, a random walk approach, or a predictive approach? Now, technical analyses, that's looking at support resistance lines, that's looking at indicators and all of that good stuff. You guys know there's over 200 different technical analyses, indicators that you can put on your chart that can help us try to define support resistance and change of direction type indicators. Random walk is just simply saying, listen, we don't know what the market's going to do. It's going to do whatever it's going to do. We can't predict that. And then predictive, of course, is where we do feel like we have the ability to sort of understand what's coming in the future. Now, I'm not going to say that either one of those is right or wrong or better or worse than the other, but the approach that you use will determine how you trade these markets. If you're a technical trader, you're going to be trading off of support resistance lines. If you're a random walk trader, you're going to be putting trades in very early in the day with a full iron condor, with both legs in, because your thesis is, hey, I can't determine where the market's going to go, so I shouldn't even try. If you are a predictive trader in nature, you'll be legging in more. And so it does determine a little bit the strategy that you're going to use depending upon what approach you use. But generally speaking, we want to wait about 30 to 60 minutes until the market opens up and establishes itself. There's a saying that I love in the market that says that the first hour of the morning of the market is opened by the amateurs, and the last hour of the day is closed by the pros. You've heard of power hour, and that is definitely true that the institutions and the professional traders take over at the end of the day. So amateurs open the market, pros close it. So we want to generally wait about 30 to 60 minutes, let the market open up, and then try to determine one of 3 things. Is the market trending? Is it range bound? Or what is the expected move? So we would look at the marketplace, and let's look at the futures contract here. This is the E-mini futures contract. We are just a couple hours here away from the market open, and we look at this and we say, okay, basically since midnight last night for me, Mountain Time, what has the market been doing? Well, it's been range bound, okay? That's important to note, because this right here, this range bound approach, that is going to largely determine for me what one of the 6 different approaches we can take in setting up our zero data expiration. It could have been trending, right? So it could have been a trending market. It could have been a consolidating market. And then, of course, we ultimately want to look at what we call the expected move. So that little brown bar right there, that gives us an idea of the expected move, and that's based off of IV, implied volatility. And so it is varying in terms of how we would interpret this and what strategy we would use. The bigger the expected move, the more opportunities we have. The smaller the expected move, now we start losing potential opportunities. These 6 strategies maybe come down to 1 or 2. So we need to look at all of that. We need to juxtapose the expected move against what the market is doing. Is it trending or is it range bound? Okay. Now, one key thing that I will say as we're looking at this information, indicators. If you are using technical indicators, we can use things like support and resistance. We can use things maybe like pivot points if you want. We could throw some pivot points on this chart right here and add those in. And you can see that those are pretty darn accurate over time as we look at those. But one thing that you do need to understand with technical analyses on anything that is a 0 DTE, anything that we are day trading, is that technical analyses not going to be too useful for us because it is a lagging indicator. It is historical data. So it loses a little bit of its efficacy. But let's go through now these 6 different ways that we could approach our 0 DTE. All right, so when we look at these 6 different approaches that we can use with setting up our 0 DTE trades, there's a couple of considerations that we always want to look at. One is the risk-reward ratio. How much money are we risking versus what is the potential reward? We want to look at the potential for adjustments. Okay, is it adjustable? And how adjustable is it? We want to also look at the time commitment. How long are we going to need to be in this trade? And then number 4 is what is the capture percentage potential? How much of that credit that we bring in is actually capturable? And that varies, obviously, from trade to trade. So these are the 4 criteria that we're kind of looking at as we compare these 6 different approaches side by side and say, okay, what's the best way to approach this? So the first one that I want to show you down here, let's use this color for just a second. The first trade that I want to show you, and we'll put this in a little box over here, is, let's name this number 1 right here. This would be a high probability trade. So this is a high probability trade, okay? And the high probability trade is going to use probably a 5 delta. It's going to use about a 5 delta trade. And you guys know pretty much what the risk graph looks like on a 5 delta trade. So let's come out here. Let's use our E-minis again. And let's clear this out. Let's go do a short iron condor, and let's put our legs out at about a 5 delta. There's about as close as we're going to get on the call side, and here's about as close as we're going to get, excuse me, on the put side. So there's our risk curve right there on that trade, and you can see that what we're looking at there, a huge amount of risk. We're risking right now, you can see we're risking about $470 to make about $30 in profit. Okay, so lots of risk and very little reward, but incredibly high probability of success, right? So what does this sort of look like in terms of our criteria up here and what it means for us as a trade? Well, a couple things. Number 1, we know what the risk graph looks like, right? So if here's our profit and loss mark, our loss would be down here, but you have these huge wings, right? So maybe down here we are risking, this would be our risk, we're risking maybe as much as $11 to $15 to profit up here, maybe $1. Okay, so it has a very wide wingspan. That's why they call them condors, right? The bird has a very wide wingspan. Very high probability of success, very wide wingspan, but very poor risk-reward ratio. So risk-reward ratio is extremely poor. Risk-reward ratio is extremely poor. Okay. Next question is how adjustable is this trade? Well, let's come back here for just a second and let's look at our premium. Premium is about 60 cents for a full iron condor. That's not very adjustable, because if you have to pay 10 cents a leg to get out, that's 20 cents to get out, and that's going to probably be closer to the close. So as far as adjustability, it's not adjustable. Not adjustable. Okay, so benefits: very wide wings, very high probabilities. That's the name of the trade, is a high probability iron condor. But risk reward ratio is really actually horrible. Not poor, it's horrible. Trade is not really adjustable at all. And time frame wise, how long are we going to be in this trade? All day. Okay, until the close. You're going to have to be in this trade all day until the close to be able to capture all of that small premium. So this now puts us into that power hour, right? We're now into that time frame where we are dealing with the pros. So our capture rate, what is our capture rate on a trade like this? Well, the capture rate needs to be 100%. Because that is the only way that the ROI, the return on investment for this, would make any sense at all. You can see, once again, when we look at this, that in this case, again, we're risking about $467 to make $32. Now, you know, $30 on $462, that's not horrible. $30 divided by 462, it is a 6% rate of return, but again, remember, we would have to have a 100% capture rate to actually get that kind of ROI. So that is the high probability trade. It has some pros, it has some cons. It is not adjustable. The risk reward ratio is absolutely atrocious. I went from poor to horrible to atrocious, but it really, really is horrible. You're going to have to stay in the trade all day long and hold it through that power hour period of time to be able to get that 100% capture rate to give you the ROI that we need. So high probability, but all of the other factors here, all of these other things that we look at, probably not too enticing. It is interesting that as over the last, I would say probably 3 years, 2.5 to 3 years, this trade, the 0 day to expiration trade, has really exploded in popularity with retail traders. And it is interesting that by and large, most of them are these trades. They are the high probability trades. But if you look at the numbers, it doesn't really make a whole lot of sense. So what would the next trade be? I said there's 6 ways that we can approach this. Let's look at the second option that we could use. The second way, the second approach that you could use to trade a 0 DTE is one of my favorites. So of the 6 ways that you could do this, this is one of the ones that I go to quite a bit, and it's called an EM trade. It stands for expected move, okay? An expected move trade. Now, an EM trade is typically going to be about a 13 to a 16 delta, somewhere in that range. Going to be about a 13 to 16 delta. And if we take a look at that type of a trade, You, again, remember the risk graph, very poor risk-reward ratio on a high probability trade. But we could come back in here and we could move this up. There's a 17 delta right there. Let's go up to that delta right there. And there's a 15 delta right there. And if we looked at that now in the risk curve, now you see that it's getting just a little bit more proportional. We're still risking about $400 to make about $100 here. That's a little bit off on generally where we would like to be in that trade. But again, the key thing here with this trade is that the risk-reward ratio now is starting to get a little bit better. It's an okay. It's okay risk-reward. Still not great, but it's okay risk-reward ratio. Generally, we're looking at something like a 3-to-1 risk-reward ratio. Okay, that's where we would try to target that. Put up maybe $300 to make a $100 profit potential, or put up $750 to make a $250 profit. Okay, adjustability. This trade is somewhat, I'm going to put somewhat adjustable. It is an adjustable trade. It's not the easiest trade to adjust, but it is adjustable. Okay. Time frame, how long would you need to be in this trade to garner a sufficient ROI? Time frame on this type of a trade should be 3 to 5 hours. 3 to 5 hours to capture 50%. So capture 50%. Okay? So this is an expected move range trade, about a 13 to 16 delta. This is a good middle of the road. As you know, every single trade has a pro and a con. There is no approach here that is a panacea of all upside and no downside. And so this is a good middle of the road trade. I do like the expected range type trades, the expected move trades. All right, trade option number 3, or approach number 3 that we could take with our 0 DTE trades is what's called a low probability trade. So we've done a high probability. This is a low probability trade. That's a B, low probability trade. Okay. What does a low probability trade look like? Well, low probability trades are usually around a 30 delta, usually right around a 30 delta. And there's some very, very interesting characteristics with a low probability trade. Now, number one is that their risk-reward ratio, pretty darn good. It's usually around a 1-to-1 risk-reward ratio. Okay, so pretty darn good risk-reward ratio. Adjustability, can you adjust it? Adjustability on this is really good. These are pretty easy to adjust. Okay, time frame. How long are we usually in a low probability trade? Well, you only want to be in these types of trades for maybe 90 minutes to 100 minutes. Okay, less than 2 hours. And our capture rate goal, capture percentage goal, would be 50%. 50% in less than 2 hours. Okay. So what does the low probability trade look like? Well, if the high probability trade, let's say that this is our profit and loss line, and the high probability trade looks something like this, right? Lots of risk down here. Here's risk. There's reward. But a big area there for that reward. High probabilities, but low return, right? Well, if that is our high probability approach, the low probability approach is going to look something like this. Let's take a look at our risk graph once again, and let's go out and let's build one of these. So now we're talking almost a 30 delta, right? There's a 28, that's pretty close. And there's a 29, that'll do. So now we look at this in the risk graph, and now you start to see some interesting numbers, right? We said that it's about a 1-to-1 risk-reward ratio. You can see in this case it would actually be even a little bit better than that. Well, very close. We are risking about $300 here for about a $200 profit. So very close to a 1-to-1 ratio there on our trade as we look at it right here. We go on our low probability trade. Okay, so now instead of this approach right here, maybe we're looking at something like this, right? It's getting closer now to a 1-to-1 ratio, that 1-to-1 risk reward ratio that we're looking for. Little bit tighter range, but the risk versus the reward starting to come in line now. So these low probability trades, I like these as well because they are fairly easy to adjust, and it's tough to get hurt too badly on these because we can build these risk reward ratios at a pretty decent probability. You can see that this is about a 58% probability. Now, if we can build a trade at a 1-to-1 risk reward ratio, you know, we're risking $1,000 to make $1,000, and we are batting about a 58% success rate. Well, you can do the math on that. You understand that that should work out and give us positive expectancy over time. So this is approach number 3, which is the low probability approach. All right, number 4 of 6 different ways that we can trade the 0 DTE is my favorite. It's my favorite if we can get the right setup to initiate it. Okay, so number 4 is the iron butterfly. The iron butterfly. Now, an iron butterfly is where we put on a full, what you would be used to calling an iron condor, but the both short legs are at the money. Okay, so an interesting risk graph. Let's just take a look at it real quickly here, and we'll come back to our table, and we're looking at the E-minis now, and we say, okay, there's where the market is, right there, right? So that's where my short leg on my puts are going to be. That's where my short leg on my calls are going to be. Let's pull this in maybe to a $10 wide spread. And let's go take a look at that now in a risk graph. There you go. There is your iron butterfly. Now, a couple of things that you can see about that. Well, boy, our probabilities of success sure fall, don't they? This is what we call the tent. And it's pretty tough to land perfectly inside of this tent. But the big thing you see here is the risk-reward ratio. We're risking about $100 to make as much as $300 or $400. Okay, so what does that look like in terms of all of the metrics that we look at on a trade? Well, again, the iron butterfly, the risk reward is amazing. It is very tough to blow up an account using iron butterflies because the risk reward is just amazing. Again, we're looking at something like a 1 to maybe a 3 to 5 risk reward ratio. Risk $1 to make $3, $4, maybe even $5 back. Okay, so risk reward ratio on an iron butterfly is amazing. Very poor adjustability. They're very tough to adjust. Okay, poor adjustability because you can see that the tent, if you will, the window that we need to fall within is pretty tight. Now they are adjustable. You can adjust them, but they're not the easiest trade to adjust. Okay, so very poor adjustability. But time frame, what's the time frame that we would be inside an iron butterfly? Guys, the goal is 10 to 60 minutes. Just 10 to 60 minutes to get that capture rate of 50%. Okay? So very, very short-term trade. Now, here's why I like this. Yeah, it has poor adjustability, but you know what? The risk-reward ratio is so nice that we can sit in this trade for 10 or 15 minutes. If it doesn't hit, we take a very small loss and we throw another one on. And we trade it again for another 10 or 15 minutes. So you can take 2 or 3 whacks at this during a day of 0 DTE trading, and because the risk reward ratio is so favorable for us, you can lose on 2 or 3 of them. Maybe the 4th one hits and you're overall profitable on the day. So this is my favorite. This is my absolute favorite way to go out and trade the 0 DTE strategy, but we have to have the right environment. Remember, we talked about is the market trending? You know, it could be trending up, could be trending down, or is it range bound? This works best for range bound markets because we need to put this trade on right at the open. We put this trade on right at the open. B, the full trade. We're not legging in. We're not legging in on this trade. We're putting the full trade on right up front. So we're doing it right at the open. We're doing it with all of our legs in right up front. And so we need to be able to have this kind of risk-reward ratio. So this is my favorite trade, guys, if we are in a sort of range-bound market. We look at the futures. You know, we don't want to see gaps when we come here and we look at the futures right now. Let's take a look at today. Today's by the way, Friday, March the 26th. And boy, to me, that looks like a good opportunity for today. That looks like a good opportunity for today. Pretty darn flat, right? At least right now. So that is number 4. Let's talk about number 5. Okay, number 5 is one of my favorites as well. And it's one of my favorites because it is an offensive way to trade the 0 DTE. So as you know, most any type of a credit trade is going to set up a defined trading range for the market, right? And we're always trying to defend that range. We're always worried throughout the trading day that the market is going to shoot up or that it's going to crash down, but that one way or another, it's going to blow through our legs, our trading legs. And so most of the adjustments that we do, most of the managing of a trade is done in a defensive manner. Well, this trade actually just flips that on its head and says, listen, if the market is uncertain today and you don't feel confident in it, let's go offensively, okay? So this is a short butterfly spread. And this is a different risk graph than we are really used to. If that's our profit and loss line, the short butterfly spread looks something like this. Okay, we've got this window here of where we have a potential loss. We call that the valley of death, and a very, very wide area of potential profits. So not a lot of profit, you know, a lot of risk right in here, but a lot of range. A big range of profit potential up on the top. So a couple things to think about. Let's just look at one first. Let's build one first and see what we're talking about. So we could come in here. Let's go to let's look at it in the table first. Let's go look at a short butterfly spread. We could use the puts. That's fine. And let's pull that up in the risk graph there. So there you go. Now there is the offensive way to approach this market, right? What if we say, listen, I don't know what this market's going to do today, but I feel like we're going to have some pretty big volatility, and I think there's probably a pretty good chance that we're going to be up above here or down below here. This is one of the few ways that you can set up a 0 DTE with an 80 to 85% probability of profit. Guys, that's about as big as you're going to get. okay, in terms of the potential on this trade. So it is offensive trade. It's when we're looking for a big move. So some of the attributes here, as we're talking again about the things that are important in a trade with a short butterfly spread, well, it does have a poor risk-reward ratio, okay? It's not the best on its risk-reward ratio. Generally speaking, we are going to be sort of risking something like $7 to $9 for every $1 of profit potential. Okay, so there's our risk, there's our potential reward. But remember that valley of death, that risk, if you will, that we are taking is a very narrow area of risk. Okay, so what are the chances of landing exactly there at your maximum risk? In this case, we can see it's $230 or $217. It's bouncing around a little bit here, but just a little over $200, 200 and let's call it $50 for a $20 profit potential. Okay, but what are the chances of hitting that exactly? Not very good. We're 84% chance. So obvious of success, so obviously just about a 15% chance that we would fall within this range, only about a 1.5 to 2.5% chance that we would fall down here. Okay, so the risk-reward ratio on this trade, it's not great, but it's not as bad as it looks. Okay, probabilities. Well, this is a very, very high probability of profit trade. This is about as high a probability of profit trade as you can do. Again, assuming that we are in the right type of market. What would be the right type of market for this trade? Well, it certainly wouldn't be a range-bound market, would it? We would be looking for a trending market, whether that trend is down or whether that trend is up. Gap openings are great for this trade, where the market, you see the futures, they've gapped up or down on the morning. That's obviously indicative of an opportunity to take advantage of some big swings that could potentially come our way. Okay, so again, adjustability, poor. It's hard to adjust. Hard to adjust the trade, but it has a very high chance of success, right? The time frame on this trade, well, the time frame for this trade, pretty much all day, guys. Pretty much all day. We've got to get through the expiration to really capture all of this result. Because if we're only bringing in 65 cents credit, or in this case 40-cent credit, again, we're pre-market here, so it's bouncing around all over the place, but let's just say 50 cents. And you have to pay 10 or 15 cents on each side of the trade, 30 cents maybe to get out. You can see, obviously, we're going to have to run that to expiration, okay? So just a couple things to think about that, but I love this trade. I love this trade because it is offensive in nature. And so often I talk to people and they say, I love the strategy, love to day trade the SPX, but today is just a little scary. It's a little volatile, and I don't feel comfortable being able to define a range. Well, here you go. Here's a perfect way to go from generally what we would do as a defensive trade, turn it into an offensive trade, okay? All right, last but not least, let's talk about number 6. Okay, number 6 is generally a approach that I use not as a standalone trade. It can be used as a standalone trade, but I generally use it as a overlay, okay? This is called a broken wing butterfly. And I do use it as an overlay trade, okay? Broken wing butterfly, very interesting risk graph. If, again, this is our profit and loss line, broken wing butterfly might look something like that, okay? It's got this really big kicker in here, so this would obviously be a bullish broken wing butterfly, right? We could do it, so all of this in here is profit. This is all profit right here. This would be loss down here. So losses would start to incur right over here. but you can see that it does a couple of cool things. Number one, gives us this little bit of what we call a kicker here, which gives us a little bit of protection. You know, if we're wrong and the market starts to trend against us here, we've got a little bit of protection there. We have a very wide, very big sort of area or swath of profit potential. And in terms of risk reward, let's just go through some of these metrics that we look at. From a risk reward standpoint, it is very good. Okay, generally speaking, we're going to be maybe risking $1 to $1.50 to receive maybe $1. Okay, so it's a 1-to-1 ratio, maybe a 1.5-to-1 ratio, but it's not too bad of a risk-reward ratio. It is directional in nature. It's directional. Okay, so you can see that this is obviously a bullish setup. Now we could reverse this and have it more so that the profit potential is down here, but in this case it would be a bullish trade setup. Okay, so when we want to add directionality to our trades, this is the best way that I know of to do that. So this is why I love to use this as an overlay. We will overlay this trade on top of our existing 0 DTE trade to give us a little bit better delta skew. If we need to skew it a little bit more in a bullish nature, we could do it this way. We need to skew it a little bit to a bearish, we could just flip that around and do it the other way. But the broken wing butterfly, pretty good risk-reward ratio. It is directional in nature. It's pretty adjustable, fairly adjustable, because it is so big on the profit sort of time frame that we're looking at. The time frame varies. So the time frame on this, it varies. It could be all day. It could be just an hour or so. But it is a very, very flexible trade from that standpoint. Okay, so let's just take a look at a broken wing butterfly very quickly, and then we'll talk about some rules that I want to use on a trade that I'm probably going to look at doing today. Okay, so if we come into our table here and we look at our butterfly here, let's go look at what is in Tastyworks here. They call it a long butterfly. And let's go look at, we can use puts. Again, let's use long butterfly. Here we go. And if we looked at that in the risk graph, you can see right there that that is very reminiscent of the normal butterfly that we've talked about before. But in this case, we would be spreading out the legs. Okay, so we would do something like that. And that would give us that bullish nature with the little kicker there at the end. Okay, the numbers on that trade, you can see there that we are risking about $200 to make about $50, but the kicker up here would give us almost a $300 profit. So risking $200 to make almost $300. Okay, so I love the broken wing butterfly as an overlay trade, laying this on top of our existing trade to maybe enhance our delta neutrality, doing it at a credit to bring in some money. You can see again that would bring in almost $300 if we hit the tent just perfectly, bring in about $45 otherwise. So very low cost trade and is a good overlay trade. Now let's go back and talk about the iron butterfly trade. Okay, the iron butterfly. So I've said that a couple of the rules that we want to look at when we are setting up a trade is we want to look at are we range bound or are we directional in nature? Looks like we're pretty range bound here this morning, and so I'm going to look at today putting on an iron butterfly for my 0 DTE trade. Couple quick rules. Number one, we want to put it on at the open. So this is a little different than what we usually do in my trading room, which is where we wait for a half hour to an hour every morning to sort of let the market get its feet and figure out where it's going. We want to do this right at the open because it's going to capture the biggest premium possible, And we're going to do a little bit wider spreads. So this is usually a $50 wide spread. $50 wide spread. That creates better theta erosion. The wider the spread, the faster the decay. Okay, and we're going to try to do a 1 to 2 capture goal. So capturing just $1 or $2. $1 to $2 capture. So what would that look like? Well, let's go look at one right now. Now, obviously, we're pre-market here, but this will give you just an idea. Okay, let's come into our trade. Let's wipe that out, and let's go to our table. Let's find the at the monies right here. Okay, we're just a little bit between them right now, but let's just say that we sold that one, and we sold that one. Let's make that a sell. Whoops, whoops, whoops. Make that a sell. Okay, and then let's go up $50. That would put us at the 39.60s. Let's go buy that back. And down here we go down $50. So that would put us at 38. Let's see if we can find that here. 55. There we go. Okay, that gives us a risk graph that looks something like this. And you can see there that it's capturing about $21 of premium, okay? Putting up about a buying power here of about $550, max profit of $825. Boy, that looks great, right? No, we're not going to capture all of that, guys. We're looking to get $1 to $2 off of this. We're looking to get $1 to $2. Maybe $100 profit off of our $500 investment, and we want to do it in a very, very short period of time. Okay, so that would be the setup, guys. We'll see how it goes for today.